Hello, friends. Everyone loves a raise. For 2026, the official cost of living adjustment is bringing a 2.8% increase to your Social Security check. But before you start planning how to spend that extra money on groceries or gas, you need to look closely at the math. The government is giving you a raise with one hand, but quietly taking it back with the other. Thanks to the new $202.90 Medicare Part B premium and outdated IRS tax limits that haven't been adjusted in 40 years, millions of seniors are going to realize their 2026 raise actually leaves them with less spendable cash than they had last year. I want to be perfectly clear right from the start. This 2.8% increase is the official federal cost of living adjustment, not a bonus stimulus check, and your actual net deposit will depend heavily on your specific Medicare and tax deductions. No one at the Social Security Administration or Medicare is going to sit down and walk you through how these pieces collide at your kitchen table. They just update the computer systems and let you figure out the shortfall when your January deposit hits. Stay with me until the very end today, because I am also going to reveal the hold harmless loophole. It is a little-known federal law that completely protects your check from dropping if the Medicare increase happens to be larger than your entire COLA raise. Most folks have no clue this shield exists, but knowing how it works can save your monthly budget if your benefit check is on the smaller side. Before we look at the exact dollars, I need to make a quick request. The rules for Social Security and Medicare shift every single year, and the government does a terrible job of explaining your choices. Those who subscribe to this channel find out about these changes in time to protect their money. The ones who don't usually find out months after the cash is already gone. Take a second to hit that subscribe button right now so you never miss a real dollar update that impacts your life. Let's start with the absolute baseline. To understand how much extra money is coming your way, you have to look at the gross math first. The official 2026 COLA is set at 2.8%. This percentage is applied directly to what the government calls your primary insurance amount, which is your base benefit before any deductions are stripped out. It is designed to help you keep up with inflation, but it is not automatic in how it lands in your wallet. Here is exactly what you need to do to track this down. First, in early December, you need to log into your personal MySSA portal at saa.gov/myaccount. Do not wait for the paper letter to arrive in the mail because those get delayed or lost constantly. Second, once you are logged in, download your official 2026 Notice of Benefit Rate Increase. Third, look at your current 2020-25 gross monthly benefit and multiply that number by 1.028. That will show you your brand new gross benefit for the upcoming year. Finally, write that number down, but do not assume that is what will actually show up in your checking account. Let's look at how this plays out for a real person named Richard. Richard is 70 years old for a real person named Richard, and he receives an average retirement check of $1,900 a month here in 2025. When we apply the 2.8% increase, we take $1,900 and multiply it by 2.8%. That gives Richard a gross increase of $53.20 per month. That means his new gross benefit for 2026 is $1,953.20. If you look at that over a full 12-month period, Richard's gross annual income goes up by $638.40. But your situation might look a little different depending on the type of benefit you receive. For example, the average Social Security disability insurance recipient gets about $1,630 a month. For them, a 2.8% raise means an extra $45.64 each month. If you are a widow receiving an average survivor benefit of roughly $1,863, your monthly increase will be about $52.16. But that $53 a month for someone like Richard isn't what will actually land in your checking account, because Medicare takes their cut first. This brings us to the Medicare Part B deduction trap. This is where the vast majority of seniors lose their raise before they ever get to touch it. If you are on Social Security and you are also enrolled in Medicare Part B, your premium is subtracted automatically from your benefit check every single month before the federal government deposits the remainder into your bank. For 2026, the standard Part B premium has officially increased to $202.90 per month. That is a noticeable jump up from the $185 that seniors were paying throughout 2025. Because this hike is mandatory and direct, it instantly eats into your new COLA raise. To figure out your true net increase, you have to follow these specific steps. Step 1, take that new gross COLA raise dollar amount you calculated from your online statement. Step 2, subtract the 2020 6-Part B premium increase. The premium went from $185 to $202.90, which means the monthly jump is exactly $17.90. Step 3, subtract that $17.90 from your gross monthly raise to find your true net raise. Step 4, plan your entire household budget for 2026 around this final net number, not the larger gross amount the headlines are talking about. Let's look at Susan to see how this deduction alters the math. Susan is 68 years old, and based on her work history, her gross COLA raise comes out to exactly $45 a month. She is thrilled because $45 can cover a few extra bags of groceries, but then Medicare steps in. Her Part B premium increases by $17.90. We take her $45 raise and subtract that $17.90 Medicare hike. The result is $27.10. That is it. Susan's actual net raise in her bank account is only $27.10 a month. Over the course of the year, she only gains $325 in actual spending power, instead of the $540 she calculated based on the gross headlines. Now, there is a major variation to this rule based on your specific state and financial situation. If you are a lower-income senior enrolled in a state-administered Medicare savings program, your state government pays your Part B premium for you completely. If you fall into this category, the deduction stops happening on your federal check. You actually get to keep 100% of your 2.8% COLA raise deposited directly into your bank account with $0 subtracted for the standard Medicare premium hike. Medicare isn't the only federal agency waiting to take a bite out of your raise, though. You must also watch out for the IRS. That brings us to the provisional income tax trap. This is a stealth tax bracket that catches thousands of middle-income retirees completely off guard, especially if you have a modest pension, work part-time to stay busy, or pull a little money out of your 401k to cover home repairs. Under federal law, the IRS will tax up to 85% of your Social Security benefits if your provisional income crosses a specific line. Those lines are set at $25,000 for single filers and $32,000 for married couples filing jointly. Here's the real kicker. Congress has never adjusted these thresholds for inflation since they created them back in the 1980s. Because the dollar limits stay frozen while your COLA raise keeps climbing, the 2026 increase is going to push thousands of seniors over the cliff, triggering federal income taxes on their benefits for the very first time in their lives. To make sure you don't get blindsided, you need to run these numbers yourself. First, calculate your provisional income by taking your adjusted gross income, adding any non-taxable interest you earned, and then adding exactly 50% of your annual Social Security benefits. Second, compare that final number to the IRS cliffs, which are $25,000 if you are single or $32,000 if you are married. Third, check to see if your new 2.8% COLA raise pushes your total math over that edge for 2026. Fourth, if the math clears the limit, you must prepare right now to owe federal taxes on a portion of your monthly benefits when you file your return next April. Let's look at Tom and Linda to see how this trap operates in the real world. They are a married couple who had a total provisional income of $31,500 in 2025 because they were just under the 30-25. Because they were just under the 30-20-25, because they were just under the $32,000 in taxes. But for 2026, their 2.8% COLA raises their combined Social Security benefits by exactly $1,000 for the year. That $1,000 raise pushes their new provisional income up to $32,500. They have officially crossed the $32,000 line. Now, up to 50% of their benefits above that threshold become fully taxable. A simple $1,000 inflation raise just triggered hundreds of dollars in new IRS tax liability, quietly wiping out the financial relief the COLA was supposed to give them. There is a second, even harsher cliff you need to know about if your income is slightly higher. For single feelers, once your provisional income crosses $34,000 or $44,000 for married couples, up to 85% of your Social Security benefits become subject to federal income tax. To combat this sudden tax hit, you have to actively manage your withholding so you don't get hit with a surprise bill or a penalty. That is where IRS Form W-4V comes into play. This is the voluntary tax withholding adjustment, and it is the single best tool available for seniors who realize their new COLA raise is going to expose them to the IRS stealth tax. If you know you are going to owe money, you have the legal right to ask the Social Security Administration to take the tax out of your check automatically each month. Doing this prevents a massive tax bomb in April and completely protects you from the IRS's 8% estimated underpayment penalty. Taking control of this requires a physical process. Step 1, go to irs.gov and download a clean copy of Form W-FOD. Step 2, select your desired withholding rate. The government does not let you pick just any number. You are legally restricted to choosing exactly 7%, 10%, 12%, or 22% of your gross monthly benefit. Step 3, fill out the paperwork and mail the physical form to your local Social Security Administration field office. You cannot submit this form online through your portal. They require the actual document. Step 4, check your next monthly statement to verify that the tax is actively being removed. Consider David, who receives a gross Social Security check of $2,000 a month. After reviewing his provisional income, he realizes his 2026 COLA raise is going to slide him into a taxable bracket. To stay ahead of the IRS, David fills out Form W-4V and selects a flat 10% withholding 4V. 10% of his $2,000 check is exactly $200. The Social Security Administration begins sending David $1,800 each month, and they route the other $200 straight to the IRS. While David's monthly cash flow drops slightly at the bank, he successfully avoids a massive $2,400 tax bill next April, $2,400 tax bill, and he completely avoids the IRS's 8% underpayment penalty, which would have cost him an extra $192. You must remember that state income taxes are an entirely different animal. Form W-4V only applies to your federal tax liability. If you live in a state like Florida or Texas, you have no state income tax to worry about. But if you live in a state like Colorado or Utah, your state does tax Social Security benefits, and you will need to contact your state revenue office directly to handle their specific withholding rules. Now, what if you don't receive standard retirement benefits, but instead rely on the strictest poverty-level federal assistance program? That brings us to the Supplemental Security Income COLA and Resource Limit Clash. If you or a loved one receives SSI, you are also getting the 2.8% COLA raise for 2026. But this raise comes with a very dangerous catch. While your monthly payment is going up, the strict asset limits enforced by the Social Security Administration have not changed. To remain eligible for SSI, a single individual cannot have more than $2,000 in total countable assets, and a married couple is capped at $3,000. Because your monthly deposit is now larger, it becomes incredibly easy to accidentally hold too much cash in your checking account, triggering an automatic suspension of your entire benefit. To protect your SSI eligibility, you must follow a strict monthly routine. Step 1, look at your exact bank balance on the very first day of every single month. Step 2, make sure that your new higher COLA deposit has not pushed your total checking or savings account balance past the $2,000 limit for an individual or the $3,000 limit for a couple. Step 3, if you see your balance creeping up to $1,900, you must spend that money down on legitimate living expenses like rent, utilities, or clothes immediately before the month ends. Step 4, keep every single grocery and utility receipt in a safe place to prove to the government that the spend down went to valid expenses. Let's look at Mark to see how fast this trap snaps shut. Mark receives SSI and is incredibly disciplined about keeping his bank balance right around $1,900 so he has a small safety net. For 2026, his COLA raise increases his monthly check by $26. Because he manages to save a little bit of his money each month, that extra $26 causes his total bank balance to hit $2,010. The Social Security Administration computer systems flag the account instantly. They suspend his entire SASI check for the following month. Because Mark was just $10 over the asset cliff, he loses over $900 in monthly benefits. There is an important legal exception to this asset rule if you are a disabled individual who opened an ABLE account. Under federal guidelines, you can shield up to $100,000 of total savings inside an ABLE account without affecting your SSI eligibility. If your 2026 COLA raise starts pushing your regular checking account dangerously close to the limit, you can transfer the excess funds directly into your ABLE account to save your monthly benefits from suspension. And if you are currently paying back the Social Security Administration for a previous overpayment, the 2026 COLA is going to change that math against you as well. That brings us to the rising overpayment deduction. This impacts any senior who is currently having their monthly check garnished by the Social Security Administration to pay back a past overpayment debt. Under recent rules implemented by the agency, overpayment recovery is generally capped at 10% of your gross monthly benefit. But because the 2.8% COLA increases your gross benefit amount, that 10% clawback calculation automatically goes up too. The government immediately uses your inflation raise to speed up their own debt collection. To know exactly what is about to happen to your deposit, you can do the math right now. Step 1, look at your January statement from the agency. Step 2, identify your brand new higher gross benefit amount that includes the 2.8% raise. Step 3, multiply that new gross figure by 10%. Step 4, expect the Social Security Administration to deduct this new higher amount from your deposit, meaning your actual take-home raise will be smaller than you think. Let's look at Linda to see how this works out on paper. Linda owes the Social Security Administration $4,000 due to an administrative mistake made years ago. Back in 2025, her gross monthly check was $1,500, so the agency deducted exactly 10%, which came out to $150 a month. For 2026, her 2.8% COLA raises her gross benefit to $1,542, but the agency doesn't keep taking $150. They automatically calculate 10% of her new gross, which is $154.20. Linda's net check only goes up by $37.80 instead of the $42 raise she expected. The government quietly takes the rest to pay themselves back faster. However, you do have a legal right to fight back if this automatic deduction compromises your ability to live. If the new 10% clawback causes severe financial hardship, you can file Form SSA-634 to request a lower fixed recovery rate. You can ask for a flat amount, like $20 a month, which completely overrides the standard 10% calculation and lets you keep the rest of your raise. But what happens if the Medicare Part B premium increase is so large that it completely wipes out your entire COLA raise? That brings us to the ultimate legal shield. This is the payoff you have been waiting for, the federal hold harmless provision. This is a powerful federal law designed specifically for seniors whose Medicare Part B premium is deducted directly from their Social Security check, and whose gross COLA dollar increase is smaller than the Medicare premium jump. By law, a Medicare Part B premium hike cannot reduce your net monthly Social Security check below what it was the previous year. If the math results in a negative number, the federal government is legally forced to lower your Medicare premium to ensure your net deposit stays exactly the same. You don't have to jump through hoops to make this work. First, review your December notice of benefit rate increase. Second, check to see if your exact COLA dollar raise is less than the $17.90 Part B premium jump. Third, do not panic if your raise is smaller than $17.90. Fourth, you do not need to file any forms or call a hotline. The computer systems are legally required to automatically cap your Part B increase to match your COLA raise exactly. Consider Mary, who receives a very small Social Security check of $500 a month based on a limited work history. Her 2.8% COLA raise comes out to just $14, but the standard Part B premium jumped by $17.90. Mathematically, Mary should lose $3.90 a month from her check. Because of the hold harmless rule, the law completely forgives that $3.90 difference. Her net check stays exactly the same as last year, and she is legally excused from paying the full $202.90 Part B premium. Over the course of the year, she saved $46.80 that she never has to pay back. You must know that the hold harmless provision does have strict boundaries. It will not protect higher income seniors who are subject to the income-related monthly adjustment amount, or IRMAA surcharges. It also provides zero protection if you pay your Medicare premiums directly out of your bank account instead of having them deducted directly from your Social Security check. Let's do a fast recap of what we covered today so you can secure your money. First, find your gross raise by multiplying your current benefit by 1.028. Second, subtract the $17.90 Medicare Part B hike to find your true net increase. Third, monitor your provisional income against the $25,000 single or $32,000 married cliffs so you don't trigger the IRS stealth tax. Fourth, use Form W, 4V if you need to set up automatic federal tax withholding and avoid penalties. Fifth, keep your bank balance below $2,000 on the first of the month if you are on SSI to protect your eligibility. Sixth, expect your overpayment deduction to rise to 10% of your new gross benefit unless you file for a hardship waiver. Finally, lean on the hold harmless rule to lock your check in place if your gross raise fails to cover the Medicare premium hike. Your CALA is not just free money. It is a vital mathematical adjustment, and by understanding how Medicare, the IRS, and the hold harmless rule interact with it, you can fiercely protect every single dollar of your new raise. Subscribe. Share this with someone you know who's on Social Security or Medicare. I'll see you in the next one.